Okay, so basically we've got, obviously we buy shares in companies. In this particular case, we haven't got as much as 50% of the shares. We have generally more than 20% of the shares, okay? So basically you have generally more than 20% of the shares, and if you've got more than 20% of the shares, it means that you have significant influence. Okay, whoops. So it means you have significant influence, and it means that you've got an associate. So you don't have a subsidiary, but you have an associate. Okay. Generally what happens when you actually buy an investment is that you simply debit the investment and you credit cash, right? Okay, so if you buy an investment, you simply debit the investment and you credit cash. However, that's if you say got 10% of the shares of a company, or you've got 5%, or you've got 1%. That's what you're going to do, okay? And then when you get the dividends, you simply debit cash and you credit dividends, whatever, income. What actually they also say is that you should actually keep the investment at fair value, so market value. So if the investment goes up, you will basically debit the investment and credit gain on investment. Okay. Generally, if the market value goes up, you should keep it at market value or fair value, so you will debit investment and credit gain on investment. Okay. So that's generally if you have less than 20% of the shares of a company. Okay. Basically, with associates, on the other hand, it's really not that difficult. What you're actually doing there is you're doing this, exactly the same thing. But what actually happens with an associate is that you will keep changing the value of the investment depending on the profits that are made by the company. So you're not actually changing the value of the investment based on market value. You're changing the value of the investment based on the profits that are made by the company. So for example, let's say you purchase an investment for 500,000. Okay. They then say that the company has made profits of, so the company that you've purchased, let's say you purchased 30%. So generally you have between 20% to just under 50% to have an associate. Okay, to have an associate, you have purchased between 20 and 49% of the shares. Okay, which means that you have what we call significant influence. Obviously, what does that mean? It means you don't have control, but you can quite significantly influence because you have quite a large percentage of the shares. So you can't make the final decision, but you certainly have a great deal of influence. Okay. Okay, so basically we've purchased 30% and we've paid 500,000. We then look at the income statement of the company. We see they've made $1 million in profits, after-tax profits for the current year. They've made $1 million in after-tax profits this current year. So what you're going to do there is you're actually going to debit the investment and you credit share of profits. Okay, what are you going to debit the investment with? What's the amount going to be? Sorry? 700,000? 300,000, yeah, that's right. Okay, 300,000, that's right. Yeah. So your investment has actually gone up by 300,000 because of the profit that was made. You take your percentage and your investment has gone up by that amount this current year. Okay. If, for example, they have paid dividends of 100,000, right? So they've paid dividends of 100,000 this year. What are you going to do there? What's going to happen? you're actually going to credit your investment. I guess you're going to, debit cash and credit investment. Okay. Basically, what's happening there is your investment is going down because of the fact that they have actually shared the profits, but at the same time, you're actually earning cash. So obviously, it's going to be 30% times 100,000, which is 30,000. I'm just going to go to the slides now, so yeah. Okay, so as you can see, the investment has increased with any profits, decreased with dividends paid. The investment is increased with any changes in capital reserves, such as asset revaluation, foreign currency translation reserve, etc. So what are we going to do in this particular case? And just going across there, the company has purchased 35% of another company for 400,000. So the first journal entry will be debit investment and credit bank with 400,000. Okay, so that was just the same journal entry as this one here. You just purchased the investment, you paid a certain amount, so it's debit investment and credit bank. The next one is simply going to be paid dividends, and as you can see, debited bank and credit investment. So if you pay a dividend, as you can see there, they've purchased 35%. Therefore, if the company pays a dividend of 10,000, 3,500 is going to be received by the investor, and their investment is going to go down by 3,500. Does everyone understand why? Okay. All good? Okay. The next thing that's going to happen is basically, what else do you think could happen that will affect your value of your investment?
Do you want to go to previous slide?
Sorry?
Do you want to go to previous slide?
Yeah, no, that's fine. Over there. Okay. Okay, the other thing, just going back to this one here, sorry. Basically, the other thing that can increase your investment is what? What do you think can also increase your investment? So we know that profits will increase your investment. We know that dividends will decrease your investment value. The only thing is there's a downside and there's an upside if you've got shares, because you're getting the cash, but your investment goes down. So basically, it's kind of, it's neutral here, because you obviously if you need the cash, you're happy about it. What else can actually increase the value of your investment? Okay. Anything that actually increases the equity of the company that you've invested in. So what else do you think could increase? We know profits will increase the equity of the company. Sorry? Revaluation. Sorry, what did you say? A revaluation reserve, yeah. So anything like that, anything that's going to revaluation reserve. They're talking about foreign currency reserves. So we haven't actually done that yet, but obviously if there's a movement in foreign currency, then quite often that will increase the equity of the company. But we haven't done that yet, so what we're going to do here is we're going to debit the investment. So for example, let's say that the land, they say in the company that we've invested in, land has gone up by $1 million. And they've credited deferred tax liability with 300,000. And they have credited revaluation reserve. So this has happened in the company we've invested in. Okay. Still just seeing wording. Yeah. Okay, so basically what are you going to have here? Debit investment, what amount? What amount is it going to be? Okay, basically what what you're going to do is take that one there, because that's the value that the company's equity has increased by. That's the value that the company's equity has increased by. Their equity is not increased by $1 million, because their asset increased by $1 million, but their liabilities also increased by $300,000. So what is their equity increased by? $700,000. So don't make the mistake of taking $1 million. You've got to go with the revaluation reserve amount. Okay, that's the equity figure. So that there times by 30% will give you 210,000. Yeah.
So with the every entry, we have to deduct the 30% of the amount.
With every entry you have to, basically, yeah, you're always just taking your share, which is 30%. You haven't got 100% of the shares, you've only got 30% of the shares. So if the profits of the company are $1 million, you only get the benefit of 30%. Okay? If the revaluation reserve goes up by that, you only get the benefit of 30%. Okay, so we're just going to pick our revaluation reserve. Yep. And anything else? Oh, that's pretty much it. Yeah. Okay. And basically what I could say to you, okay, what's the value of the investment in your balance sheet at the end of the year? Current year, what's the value of the investment? And you should be able to tell me that quite easily by just drawing up a T account. No, T account, 300 debit. So we've got 300 here, credit investment 30, debit investment 210, so 510 minus 30 is 480. Yeah. Value of the investment in your balance sheet is going to now be 480. Okay, so that's quite a nice increase after you've purchased it for 300,000.
Wasn't the purchase 500?
Hang on, you're quite right. Sorry, this should be 500. Actually, there should be another figure in there. I've missed that first journal entry. Thank you for that. So you've actually got 500 here. You've got to obviously take this as well. First journal entry there was 500. Then we have an additional 300 share of profits. Take off 30 because that's the dividend paid, and then the 210. So we've actually got 500, 800, 1,010,000 minus 30, about 980. Is the value of the investment. Yeah, thanks for that. Very important, that first one. Okay, easy. Okay, just a quick, what I'm going to do is just give you a quick little question, and you can do that, and you should be able to do that fairly easily. So, a purchase. And then we'll look at that sheet of paper I gave you just now.